Lyn Alden is founder at Lyn Alden Investment Strategy, and she's joining us now to take some questions. Lyn, good to have you with us here. Thank you very much. Is this a bit of a game changer from a tactical perspective for markets, what we've seen between US and China, Lyn, on the way up in terms of risk on? What's your sense?
So certainly, tariffs were the biggest weight on global markets. And so with a significant release from that, that allowed obviously markets to rally today. And as long as there's no re-escalation, this is pretty constructive. I'm bullish on Chinese equities here. And broadly, ex-US equities are pretty attractive. Financials globally are pretty attractive. I still think there's some weight for the rest of the year to some extent on US equities and markets because the tariff rates are still pretty significant and there's still considerable uncertainty. But this is certainly a welcome development compared to how we were last week and the week before.
Lyn, hi, great to have you on. Okay, take your point. It is a welcome development for sure. And it did catch the market by surprise. I think the extent of the rollback from 145% to now 30% tariff on China. Does this give enough ammunition to the market, US equities or even Chinese equities for that matter, to look at a fresh leg up?
I think there's a good chance it does. The prior tariff rates were essentially an embargo. When kind of analyzing different companies, say throughout the U.S. that import Chinese products, many of them were in complete standstill. They had little idea of how they were going to operate in the coming weeks and months when you're at literally over 100% tariffs. And when you're looking more at 30% tariffs, well, that's still a major burden. Businesses can find ways to operate around that. So that gets at least back to normal business functioning and allows probably Chinese volumes to be decent. And it's more of a margin issue on US corporations and US consumers. So I think this at least puts us back into there's a clear way forward here, even though there are still some weights, particularly on, for example, US corporate margins and therefore, 12-month stock market potential.
All right. Hi, Lyn. Good morning. Good to see you. Lyn, so what's the preference? You're bullish on Chinese equities, as you just said. But between developed markets and emerging markets, what's the preference out there? And where does India come? Because we have had a good run. But if you're bullish on Chinese equities, then where does India stand? Please go ahead.
Yeah, so I have a preference overall for emerging markets to developed markets here. One exception maybe is financials. I like them both in developed and developing countries. But in terms of broad equities, I think emerging is more attractive here. While India is attractive, it had a nice run recently. And overall, there's still decent news priced into it compared to some other markets. I think China is still kind of unusually inexpensive. So it's mostly a valuation play in that sense. And I would put Brazil in a similar bucket. So they're more value plays. So I'm a little bit more tactically bullish on those. But I think broadly, Asia in general, parts of South America, pretty strongly positioned right now. And even if these tariff issues do re-escalate at some point, Asia in general, multiple countries have very strong negotiating positions. We saw, for example, the Association of Southeast Asian Nations last week came out with a pretty strongly worded joint statement, along with some of their partners, China, South Korea, and Japan, reconfirming their commitment to global trade. Particularly between themselves as well. And so I think overall Asia is very strongly positioned, both tactically and structurally.
But Chinese equities over Indian equities at this juncture, given the valuations, is that correct?
Moderately, yes, but I like both. Between the two, I would err toward China at the moment.
And guys, Chinese exports should be red hot, right? Because, you got this 90-day pause. Who knows what will happen after 90 days?
But now for 90 days, only 30%.
Imagine if you're a Walmart, you'd buy
stock up.
Christmas supplies for 2025 and 2026. Right? So, I think it's going to be a big push out, which we will see. Lyn, thank you very much for joining us and running us through all of that. Appreciate your time here on CNBC-TV18.